Thank you once again for joining us this afternoon on what's quite a wet afternoon now, but here in Bristol. Um, we're delighted to be linking up with Bristol Law Society. It's the first sort of partnership, certainly the Bristol office have got involved with another professional organisation locally, and we're certainly keen to make the most of it and doing collaborative events where we can share our knowledge with you, the membership, is something we're really excited to start off with today, and we look to continue that collaboration through a series of events that we're planning at the moment. We are very much, looking forward to developing a partnership. So if there are any subjects that you would like to see JMFin cover, then please do get in touch with us or BLS, and we will look to include that in our programme going forward. For those that aren't familiar with our firm, JMFin offer personalised wealth and investment management services to our clients. We have about 18,500 clients that we look after in the UK. Most of them we manage on a discretionary basis, and we have a little over 11 billion in assets that we manage for our clients. We have 77 investment managers working in our firm, and that's across 5 different regional offices. Bristol has been up and running for a long while now. We've been based in Bristol for more than 20 years, and we've got a very established team in the city. We manage over 1 billion of client assets through our office, and we have a lot of links in with the professional networks locally. But we're always looking to develop more connections to the legal professionals that work around us. So please do get in touch if you've got any investment queries. But yes, I mean, we're delighted to be today looking at pension planning, which I think is something that's important for people to look at throughout their career, whether they're at the start of it, middle, or heading towards retirement, and thinking of how to fund that. So I'm not going to take up any more of your time. I think Charlie and Rebecca have a lot to cover, so I'm going to pass you on to my colleagues in our wealth planning team who can give you a bit more information. Thank you.
Afternoon all, thank you again for joining us. As Helen mentioned, the webinar is on optimizing your retirement planning. The plan today is to provide you with a few tips, insights to support your retirement planning journey. The session is hopefully, as I said, going to offer you some sort of a high-level overview and bringing together a range of important topics. The aim of the presentation is to keep things straightforward and easy to follow, so apologies if we don't go into huge detail, but we can always follow up with that, and hopefully any questions you have might be useful. Thanks, Claire. Next slide now. So by way of introduction, we were 2 of the chartered financial planners at JMFin. Now it's just me. I'm Charlie. I've been with the firm for a couple of years now. I've been in the industry for about a decade, so have a lot of experience looking after private clients and individuals like yourselves. Our role is to support clients in managing their personal finances, offering guidance across key areas: pensions, retirement planning, tax planning, inheritance tax planning, and estate planning. We work closely with the investment managers at JMFin, the likes of Isabel and a couple of her colleagues who I believe are on the call as well as other professional advisors like yourselves, being solicitors, accountants. The reason why we do that is to ensure a sort of joined up synergy and a combined approach to financial planning that works in the best interest of the individuals. Typically, we find ourselves engaging with clients at all stages of life, and are often contacted during significant life events, so retirement, death, divorce, i.e. when financial decisions are especially important. Where appropriate, of course, we will signpost clients to trusted external parties if their needs fall outside the scope of our services, which can be the case sometimes. As an example, we act on UK advice here. We don't work on behalf of foreign jurisdictions. So in those instances, we may hand over to other parties that have more experience in that front. So yeah, just talking about the the slide that we're on now, Claire, that's fine. The areas we want to cover today are how to build a retirement plan that ensures long-term financial security, pros and cons of consolidating pensions, your main options at retirement. Again, we won't delve too deep into those. I'm conscious probably most of you are aware that those options are changing, lifetime allowance, lump sum allowance, tax-free cash, etc. The role of the state pension and what happens to your pension when you pass away. Thanks, Claire. Next slide. As Helen mentioned, sorry, just quickly in advance, we will have a Q&A at the end, so any questions we can cover off. So first slide here is how can I ensure I retire comfortably? I think the key considerations are the steps on the steps here. I think there's several key actions we recommend, and the reason for that is we want individuals to have a secure and fulfilling retirement. If we just start from the bottom step, an important starting point is to set some goals. Start by imagining your ideal retirement, i.e., asking yourself questions: when do you want to retire? Where do you want to live? When, are you going to retire immediately? Are you going to gradually retire? What will you do during your retirement? Hobbies, volunteering. The whole idea of it is to shape your financial needs, which enables the likes of ourselves, professional advisors, to help you with a planning strategy to ensure that it's sustainable for the longer term. I think in terms of 1B, calculating your retirement expenditure is obviously extremely important. Understanding how much income you'll actually need. As a point of reference, according to the Pensions and Lifetime Savings Association, a comfortable retirement for a single person is around about £43,000 per annum. For a couple, it's more like 59,000. So keep that in mind. Of course, everyone's expenditure is different, lifestyles are different, but at the same time, it's worth considering that that's a sort of standard figure. Of course, some costs may increase during retirement, medical expenses, insurance. Others may decrease. Your mortgage might be paid off. You may have some school fees, etc. Moving on to step 2 on the ladder there, it's a sort of assessing your current financial position, i.e., we think it's extremely important to take stock of what you already have, sort of to review your existing pensions and savings and bonds and assets and mortgages. Effectively performing a sort of financial MOT is what we term it. Asking yourself questions that is what you've got appropriate for retirement? Are the charges you're paying competitive? Are you invested appropriately? Those sort of questions are often really useful. Thereafter, once you've taken that financial MOT, as we term it, it's all about formulating a retirement plan to plug any gaps that you have. If there is a shortfall, create a plan that considers, investment term, how long you're going to live, risk profile, how risky, how much volatility can you afford to have, and then come up with a final solution as to what savings you really need. There are tools and online calculators that you can use to produce this, and we undertake something called cash flow planning, which is effectively a extrapolation of current requirements over the longer term. I think all along the way we've sort of come up with a plan now. Thereafter, step 4, sort of halfway up the ladder at this point, is about contributing to a pension and using tax efficient allowances. Specifically, we're talking about retirement planning today, and the majority of that is obviously made up of pensions. And as we all know, there are some generous tax benefits with pensions. I mean, you get tax relief on contributions. So a basic rate taxpayer, i.e., someone that earns up to just about £50,000, receives 20% tax relief at source. A higher rate taxpayer up to 125,000 would still receive the basic rate tax relief at source from the pension provider, but also be able to claim back an additional 20%, i.e. 40%. And similarly, for an additional rate taxpayer, they have the ability to claim back 45% on their personal contribution. So it's worth doing. And effectively, that reclaim is offset against income tax liability. Further benefits of pensions are obviously their tax-free growth within the wrapper. So start young, contribute early, build up those pension pots. A lot of benefits and a lot of workplaces these days have employer contributions, which some people look as effectively free money. Employers have to contribute on your behalf into pensions over certain thresholds. And then furthermore, which may be relevant to some of you here today, there's options such as salary sacrifice, which can effectively control the income that you receive by mitigating it or giving it up in place of further pension contributions, i.e., where you're around certain thresholds, perhaps around the 50,000 mark or the basic rate band, or over and above the £100,000 mark. Often considering salary sacrifice can be useful to control tax liabilities. Again, as I referred to earlier, our typical ethos is start early, contribute regularly, and top up when you can. Clearly subject to sort of cash flow availability. Next rung on the ladder, paying down debt and considering ISAs and other tax-free allowances alongside pensions and savings. Aim to reduce debt where possible. Later in life, in retirement, we don't want to have significant mortgages or liabilities against your name because cash flow can become a little bit more difficult. And at the same time, consider ISAs for flexible tax-efficient savings. Again, dependent on cash flow. Getting to the top of the ladder at this point now, considering longevity, plan for a long retirement. As a point of interest for all of you, a healthy 65-year-old woman today has a life expectancy of about 87 years old. As a point of reference, when the state pension was introduced in 1908, life expectancy for a woman was just 53. So you can see in just over 100 years how life expectancy has changed, and therefore how much longer term retirement planning needs to be at the same time. Effectively, we've come a very long way with healthcare and otherwise. And lastly, I'll say it throughout this webinar, but seeking professional advice and monitoring regularly is so important. There are lots of global life events that occur, and these can significantly change your position in retirement. So, working with a financial professional, someone like ourselves, and monitoring this on at least an annual basis in retirement is extremely important. Next page, Claire. Thank you. Hopefully that's the consolidation page. Thank you. Yeah, terrific. So in terms of consolidating, a key question we get asked a lot, as we all may experience, is that lots of employers throughout a working career these days, lots of different pensions with lots of different providers. Even within a similar workplace, you may have had 2 or 3 different pensions because they might have been acquired or moved or something else. As I said, a pension consolidation refers to the process of combining those multiple pensions into a single plan. In terms of the benefits of that, it simplifies administration, less paperwork, fewer statements, less providers to deal with. Furthermore, greater investment oversight. It's easier to monitor one pot. Often they have apps on phones and manage that. Access to more investment options. Some of the newer, more flexible providers allow discretionary fund managers like Isabel and JM Fin to have access to the accounts and invest on your behalf, which hopefully therefore leads to improved performance through better selection, better strategy, whether that be for the short term or longer term. And then furthermore, for yourself and your beneficiaries, easy retirement planning. With a clearer picture of your total pension pot, it's easier for you to have a longer term strategy. And then while slightly morbid, it does simplify death benefits for your beneficiaries, whomever that may be: kids, children, grandchildren, friends, charities. Having one consolidated pot makes life easier, being able to deal with one provider instead of lots. On the flip side, of course, it's always important to acknowledge the possible drawbacks. With pensions and pension consolidations, there is the risk of losing guaranteed benefits. Some plans and older plans may have things such as protected tax-free cash, guaranteed annuity rates. These are, benefits that are applied to specific plans. The loss of special features is something that's particularly important, and particularly if you're foregoing an active plan, something that's being contributed into, you may lose employer contributions, which is effectively giving up benefits. A final consideration might be something along the lines of exit fees, increased charges, those type of things, which in advance of a consolidation exercise is really important to consider. Essentially, the most important thing to consider with pensions, and especially for older occupational pensions, is that they can be complex, and there are intricacies and benefits that you may miss out on. So, seeking professional advice before consolidating ensures that you don't lose anything. So next slide, please, Claire. Thank you. So this page here, what choices do I have at retirement? Along the right here, you can see some of the terminology and words that we use in retirement. we're not going to delve too deep into them. If we do need clarity, perhaps we can go through them if there are any questions. But particularly now, what we want to do in respect of the pensions is cover off the different types of pension specifically. And the most common form of a pension these days is a defined contribution pension. And in advance of even discussing that, I think what's important to consider as well is that when we think about retirement planning, you often think about your pensions. But actually, the reality is you may have several sources of income to draw from, including savings and investments, cash at the bank with HSBC. You might have rental properties or buy-to-lets. You may then have defined benefit pension schemes, which we'll come on to discuss a little bit later. You might have the defined contribution schemes, which again I'll discuss shortly. And furthermore to that, you may have other sources of guaranteed income, such as the state pension or other annuities. In this section, we're going to focus specifically on defined contribution pensions because they are the most common these days. These pensions are typically the ones that you have at your employers at the moment. It's the value comes from the amount paid in by you and your employer on a monthly basis. But however, it also includes an investment growth element of the fund. Examples and terms you may have heard associated with these that are defined contribution pensions, are personal pensions, stakeholder pensions, workplace pensions, or a very common one that you often hear these days is a SIP or a self-invested personal pension. Where these have become more popular these days is following pension freedoms, which was a landmark change in 2014-15 when the then Chancellor George Osborne introduced pension freedoms. So at that time, the key changes, what that happened at that point, was it gave individuals the ability to post-retirement age, which was 55 at the time. It's about to be 57. By the time I get there, it probably was 60 plus. What it does is it gives the flexibility how you access those defined contribution pension pots. So these days, the current rules are up to certain thresholds. Of course, you can take 25% of the pension pot tax-free. Then the remaining 75% could be taken, could be left invested. It could be used to purchase an annuity. It could be drawn down through flexi access drawdown, or it could be taken to lump sums, some of which may be subject to taxation. I think the question, again, I ask myself is why is this so significant? Before 2015, most people were required to buy an annuity, which it provided a guaranteed income for life, which was a huge benefit, of course, gave you certainty. But there were a couple of drawbacks. The first of which was that if at the time you took out the annuity, rates were poor, the income potential that you would receive was less. And obviously, once that's locked in, it's locked in for life. Furthermore to that, you might have accrued significant amount of pension benefits over the career, a 30, 40, 50-year working career. Early death could mean that you lose that value to an annuity provider unless it was protected. Drawdown was introduced in 2015 as a reason to correct that. It allowed people to take 25% tax-free cash, defer that annuity purchase until such a time that it became useful. Thanks, Claire. Next slide now. Perfect, thank you. What role could the state pension play? I think again, as we all know, the role of the state pension is that it forms a foundation in retirement, particularly for sort of covering essential costs. And therefore, one of the key points that we often like to consider is budgeting in retirement, sorry. And what that is sort of weighing up your essentials versus your lifestyle, or your discretionary versus your non-discretionary. Essential expenditure, sort of day-to-day living costs, food, groceries, electricity, council tax, broadband bills, otherwise. Lifestyle expenditure, on the other hand, is more flexible and focused on enhancing sort of the quality of your life. So holidays, dining out, gym memberships, Netflix, other things like that. And therefore, as I said earlier, where the role of the state pension currently fits in is that it's particularly useful for covering those sort of non-discretionary or those fixed costs, as it were, the essentials, covering your water bill each month, covering some of your electricity, your Netflix, etc. Oh, not your Netflix, sorry. Apologies, that's not an essential. Some of the key facts sort of surrounding the state pension is that it is it's a complicated thing in itself. The new state pension now applies to those reaching retirement age after the 6th of April 2016. Prior to that, there was the old state pension and the additional state pension, which we'll come on to a little bit later. With the new state pension, it requires at least 10 qualifying years of national insurance contributions or credits to receive some sort of pension, i.e. 10 full years of work. 35 years qualifies you for the full state pension, and currently the full state pension is just over £230 a week for 25-26. That totals just under £12,000 a year, so it's still a meaningful sum. I think one very important point to note that people often don't realise, and I think is covered off with one of the questions that you very kindly asked, was that it is paid gross, and therefore no tax is deducted at source, but it is taxable. So we need to consider that when you receive your state pension. In respect of the state pension, I mentioned about the qualifying years. There is the ability to top up your state pension. If you do have gaps in your national insurance record, you can usually pay voluntary Class 3 national insurance contributions. You can backdate those 6 years. So if you have 25 years of contributions and you haven't worked for 6 years, you could backdate those 6 years and therefore thereafter have 31 years, which would mean more state pension for you. The cost to do that for a completely empty year is somewhere between sort of £800 to £900 typically, and most of the time that extra payment is accrued in about 2.5-3 years, i.e. the benefit you receive pays off that liability in about 2-3 years. So it's definitely worth doing. How you check your record, you can do that via your personal tax account via gov.uk. It requires a government gateway login. You can register for those using your payslip or a passport. And what you'll do is once you get presented with the data, you can look through your individual years and see what's been marked as a full year, what's not full. And then some of the years, unfortunately, will say too late to pay for this year. In that instance, unfortunately, you've missed out on that year. It is, of course, as I mentioned earlier, worth considering that there are other ways to accrue a state pension. So we mentioned national insurance contributions, and I did briefly touch upon credits. Free national insurance credits may be available if you're caring for a child under 12 via child benefit. A family member is caring for your child, you can transfer credits, or you're a spouse of an armed forces officer. You're eligible for employment and support allowance, but you may not claim it, but you still get the credits towards your state pension. I think at this point, it's obviously worth addressing that there are a number of challenges that do face the state pension. Primarily, it's the aging population. As we all know, and as I referred to earlier, longevity is increasing and continuing to do so. Clearly, that puts pressure on public finances, and therefore there may need to be a change at some point to stop this. Typically, the state pension increases by something called the triple lock. So what that does is it guarantees the highest of inflation, earnings growth, or 2.5%. And just as a point of reference for 24-25, this resulted in an increase of 8.5% for all state pension entitlements. And therefore, that's a significant burden upon the government and public finances. Another challenge, of course, that they continue to discuss and is being raised is raising the age. What that could obviously do is disproportionately affect those with a lower life expectancy. So the government is continually thinking about how to manage that to the best of the ability. And I think Rebecca's back as well, I've just seen. So would you like to take the next page from here?
Yes, that's fine. Assume you can hear me.
We can, loud and clear.
Great. So that the next slide, please. Brilliant. Thank you very much, Claire. In terms of pension schemes and the different death benefits that they offer. So in terms of a breakdown, we can start with defined benefit schemes, which Charlie has briefly touched on already. So the defined benefit scheme is based on the final salary and the length of the scheme membership. So typically that will provide a spousal or civil partner pension on passing, and a dependent children's pension as well, usually if the child's under the age of 23. There's typically no lump sum on inheritance. So the income stream will stop on death or provide those, a slightly smaller income stream to the spouse or dependent. The capital used to provide the pension is retained within the scheme and redistributed to other members. So these schemes are relatively inflexible. Now, with defined contribution pensions, these are the more common schemes that you'll see these days, and they're based on contributions and investment growth. So they have more flexible death benefit options. You could take a lump sum, you could take an annuity, or an inherited drawdown pension where your beneficiary receives the pension as a pension and it can remain invested. The tax treatment of the pension on death does depend on the age of the member when they pass away. So before age 75, benefits are usually tax-free to the individual receiving them. If the member passes away after age 75, the benefits are typically taxed at the beneficiary's marginal rate of income tax. Okay. And then finally, the state pension. So the new state pension does stop on death. There's no pension that will follow on from that for the spouse or any dependents. However, for those who reach state pension age before April 2016, there may be a spousal benefit for individuals who were receiving the basic or additional state pension. There's no lump sum or inherited pension under the new system. I think that takes us on to questions and answers. I think we initially had a few that have come through. So Charlie, shall I kick those off?
Yeah, why don't you go with the first one? Yeah, I've got them printed out here as well. So yeah, why don't you start with number one?
Perfect. Okay, so the first question we received was, what strategies have you found the most effective when planning to maximise income in retirement? Now, this is, this is quite subjective and it depends on every individual's circumstances. But what we would advocate for is utilising all the allowances available. So, for example, with your pensions, do ensure that you're maximising those contributions where possible, and have the conversations with your employer around whether if you increase your contributions, whether they'll increase theirs. So utilising those allowances is very important. In addition, you have allowances with ISAs, so trying to utilise that allowance of £20,000 a year. That provides tax-free income in retirement as well. And utilising all other forms, including capital gains tax allowances and dividend allowances.
Brilliant, thank you. Number two, next one we've got here is, do you think it's better to consolidate previous pensions or leave them be? Hopefully I answered that question pretty well in one of the slides. I think our typical take on it is that there's no perfect science to it. Check the guarantees, the benefits that apply to the plans that you're consolidating or considering transferring. And thereafter, one of the key factors, especially when choosing your new pension, is to consider sort of 3 points. The first of which is investment choice. The reason for that is a level of diversification is good, and hopefully it will make your portfolio invested appropriately and therefore allow for positive performance. More than that, obviously the retirement options as you get closer is extremely important, and then thereafter the death benefits as well. So those are the sort of 3 considerations that you should take when considering a consolidation.
The third question we received was, where best to invest for my pension? Now, this depends on a few things. Firstly, the investment term horizon that you have and your risk profile. And then back to diversification, which Charlie mentioned previously. This is more on the investment management side. So we have a few investment managers on this call from JMFIN who I'm sure will be pleased to have a conversation with any of you about investment choice. But it's specific to each of you and your requirements.
Great. Next one is considerations as to how to maximize retirement funds in the age bracket of 30 to 35. Yeah, I think we, again, slightly touched on it earlier, but just to go into a little bit more detail, I think utilizing those tax efficient allowances that you have in respect of retirement funds, I think the important thing is to consider that there's a lot of investment options available to you these days in terms of wrappers or accounts. It's not just the pension. Think about your ISAs. Think about other things such as bonds perhaps as well that may be appropriate, but really our thought process is surrounding sort of how it's invested. Typically over the longer term, equities will outperform anything else, while they are more volatile, hopefully the performance will be better. And therefore, especially in respect of retirement funds, if you're 30, 35, you've probably got 25, 20, 30 years ahead of you. And therefore, you're able to sustain a little bit of volatility and hopefully get the investment performance on top of that. So I think, investing regularly, using your allowances and ensuring appropriate investment allocation is really important.
Okay, is it always advisable to draw down the tax-free lump sum? So in short, the answer is no, it is not always advisable. The longer answer really is bespoke to every individual. So I do suggest speaking with a financial advisor about your personal situation, whether or not it's the right thing to do for you at that time.
Thanks. Next one, increased pension payments versus increasing mortgage payments. Again, unfortunately, not a straightforward answer here. Whoever asked this question, I'm sure we can delve into it in more detail. I think the reality is it depends on you as a person. Some people like to have no debt. Some people are happy with debt because they believe that active management and investing is going to outperform that debt. The reality is it depends on you as a person and what rates are looking like at the time. So unfortunately for that question, there's not a straightforward answer. We sort of covered the benefits of pension payments. Of course, on the flip side of things, there are positives and negatives to paying off your mortgage. So not a straightforward one. Need a little bit more detail to answer that one.
Is your state pension taken into account when calculating tax on your personal pension? I think this was covered in the presentation, but the answer is yes. So the state pension is taxable, but it's paid gross. So the tax you would pay on your state pension is paid out of the other income stream. So effectively, your tax code is adjusted to take into account the state pension and any other income that you have.
Perfect. And then the last one we've got here now, I think there's a few coming through, but is surrounding pension funds and how much they're going to, or pension fund fees. What should I be expecting to pay and what is too much? Again, bit of a broad question, but I think typically we have a panel of preferred SIP providers, which is the self-invested personal pension that I discussed earlier. Typically they charge, we prefer a fixed fee approach. So the wrapper, i.e. the pot, the account, charges somewhere between sort of £300 to £500 a year. Of course, it's worth caveating on top of that, you're likely to have sort of fund manager charges. So that may be a charge to hold a fund unless you're holding direct equities. And then typically in our circumstance, you would also include something like an investment management fee or a wealth planning fee. That's something that would be agreed in advance. So in terms of giving actually figures for the total package, it's very difficult to say. Your sort of bog standard, old school personal pension with poor freedoms, poor investment choice might charge you 0.5%, even less a year. Then you go all the way to the other side. And once you add on all the add-ons, the advisors, the active management from investment manager, typically you're looking somewhere just north of 1%, maybe about around the 1.5% mark. Of course, it's worth saying that, as your pot grows, typically that number comes down.